Hello and welcome to this very special series, Wealthwise, which has been brought to you by Baroda BNP Paribas Mutual Fund. It's an investor education initiative. And joining me today is a very special guest, Suresh Soni, who is the CEO at Baroda BNP Paribas Mutual Fund. But more than that, he is someone who has started his career as a fund manager when the private mutual fund industry was just about starting, and has held multiple roles. And there are very few people who probably understand equity markets the way Suresh does. Thank you very much, Suresh. As always, it's a pleasure talking to you. Today, we are putting the spotlight on SIPs. And my first question is, many young people, and we saw that during the COVID period as well, the numbers and the data which has come out even from the regulator, that a large number of people started, opening demat accounts, trading accounts, and started trading. And this has, of course, been a question you've been asked probably many, many times, the difference between trading and investing. I just feel it's become even more relevant now because we are seeing a lot of young people coming to equities, which is a good thing. But we are also seeing a lot of people coming and trying to do trading as a way to invest in equities. So could you explain to our viewers what is the difference between the two from a mindset and skill point of view?
Wonderful. Very good questions, Vivek, and delighted to be talking to you and through you to the viewers. First thing first, very frankly, the equity market, indeed, as you pretty much said, have seen a greater participation from the investors. This is indeed one asset class which creates enormous wealth. There's nothing else that comes to, no other asset class that comes close to equity in terms of the potential to create wealth. Over a period of time, you have seen this asset class compounding wealth at high teen levels over the last 20 years plus. But at the same time, we have to remember one thing, that this is an asset class which is inherently volatile, which means that it gives you short-term opportunities, but at the same time, it also carries some short-term risk. SEBI had done a study recently where they came out with their findings by checking the patterns of investors and traders over a period of time. And the study very clearly demonstrated that more than about 85 to 90% of people who trade lose money. Now, this is a very stark study in a way, if you see. This is an asset class which compounds wealth, at least at a rate which is twice the bank deposit rate. And yet about 85 to 90% of people who are trying to trade it end up losing money. And which comes back to the same point that many of us make all the time, that short-term movement of the markets and individual stocks are very difficult to forecast. The only way to make money in equity, therefore, is to be a little patient and invest for a long period of time, rather than trying to time the short-term movement of the market. There would be sometimes when we get an illusion that we are making money. And I think most of us would have seen that through the rise of the market in the post-COVID period. But subsequently, to continue on a winning streak is nearly impossible, and which is why 85 to 90% of people who are trading end up losing money. So my sincere advice to all the investors will be to take a view of investing in the market rather than trading.
Suresh, one of the, and you alluded to it about volatility, and, over the years, whenever we've spoken, and even more recently, you had flagged off that, volatility is here to stay. And, as we, as a nation, as a stock market, become even more bigger and more global, factors which will determine volatility will probably not just be domestic, but global as well. Of course, with what has happened is that probably when you started your career, or I started mine, 100-point rise or fall, we would say, crashed. Today, that number is 1,000 or 1,500, but in percentage terms, it's probably the same. How can an investor, but this creates scare in people, when they suddenly see sharp movements. And I think that is where the point that you made, that you have to overcome the fear of volatility. But what is the best way to do that and stay invested?
Sure. So the reality is you can't change the nature of the beast. You only have to learn how to ride the beast. Over a period of time, it will take you far, provided you are able to survive short term. So you need to have kind of a bifocal vision when you are investing in equity. To make money for long term, you have to survive the short term. And that is the reason why you have to invest according to a financial plan, or probably when you're considering equity mutual fund, maybe use something like SIP, which allows you to invest regular sums at regular intervals and accumulate wealth over a period of time, rather than trying to get in and get out of the market.
Suresh, you mentioned SIP, and it's become a buzzword today. I mean, many people probably understand SIP and don't understand mutual fund. So it has become a household name in that sense. But could you outline the benefits? Because one keeps still hearing commentary that, look, if the market is down, you can put in lump sum. In the long run, it doesn't matter. So can you give some sense, given your vast experience, about why SIP may be a good way to invest, even for someone who probably is not earning monthly, or has got a bonus or something, and you deploy it periodically rather than putting it all together?
What SIP does is actually it does two things. One, it invests according to the rhythm of inflow for most people, which is essentially it matches the outflow to the income profile. And as your income for most people comes monthly, investment also happen monthly. But other than that, what it also does is that when it is spreading the investment over a period of time, it allows you to participate in the market at different levels. And as a result, what you get is an average entry price rather than a particular day entry price. So if you're doing SIP over a period of, let's say, 3 or 5 years, you'll get average entry price of those 3 and 5 years, rather than just making one particular point, which could have actually been a high point of the market. So it reduces the volatility. Because you are buying at various points of time, you're getting an average price rather than getting a particular price. And therefore, your return profile is not dependent on a particular day, but it is broadly reflecting the market movement. And to that extent, this is a very interesting and amazing tool, which allows you to defray your investment in a manner that reduces the volatility. But equally importantly, there is another aspect to it. Because you invest a certain sum every month, when the prices are low, you buy more units. So let's say if the market is, let's say, down today, and you're investing 10,000 rupees a month, probably at 10 rupees, you'll get 1,000 units. And if the market goes up at 12 rupees, probably you'll only get about 8 plus units. Therefore, you're buying more units at lower prices and less unit at higher prices, effectively bringing down your average cost. So 3 things out here. 1, matches the income profile to the investment rhythm. 2, gets you average prices. And equally importantly, allows you to get more units at lower prices. And therefore, kind of gives you better weighted average. And finally, because it is a regular investment, it takes away your focus from day-to-day movement of the market and gets you a little more disciplined in terms of investment in the market. The reality, again, as we spoke earlier, the market will remain the way it is. It will remain a volatile creature because that's the way the markets are. They are driven on a day-to-day basis by news flow, emotions, liquidity, and various actions by central banks or geopolitics that you can't take away. What you need to do is you need to invest in a manner that you are able to take the advantage of the market rather than getting shafted by the short-term movement.
Suresh, does an SIP work only in equity, or does it work in debt as well? Because many people feel that it's a tool only for an equity mutual fund. But, while I know that there are other, issues around debt mutual funds, but the fact is that, They are also now volatile. If you're investing in a debt security that is also, traded, that also comes with its own set of volatility. So is an SIP a good tool across asset classes? I'll even add gold to it, for example, if you're buying an ETF. Or is it something that you feel works for equity better than for other asset classes?
So one thing I think from a degree of magnitude perspective, the volatility in debt tends to be significantly lower than equity. And also in debt, you have a defined return path because you are investing at a certain YTM. And to that extent, delaying investment in debt is not necessarily a great idea. However, if your income profile is such that you are getting regular inflows and you want to match it from investment perspective, you can do SIP in debt as well. Gold is an asset class which tends to be a bit volatile. And to that extent, equity and gold, both I think are relatively by default, your choice should be to invest by SIP.
Suresh, while the industry and all of us have talked a lot about the benefits of SIP, and of course, we'll have to continue for many years because even though we've seen strong investor interest in mutual funds, but it's nowhere close to, a number that somebody like you would be happy with, or, there's just so much more to do. But I feel that, one of the tools, great tool for drawing down on your money, and this is relevant because I think a lot of people still feel or have this misconception that once I deploy in equity or I deploy in a mutual fund, can I take the money out? What if I need it for, I want to start up today? A lot of young people are, choosing to go the startup route, which could mean that for a certain period you have no income and you want to draw down on your savings. And then, of course, there is the regular retirement. There is so SWP, or the systematic withdrawal plan, which has a lot of benefits. I think we don't talk much about it. So my question to you is SWP a great way to draw down when the time comes when you need the money?
So SWP, you very rightly said, or systematically withdrawal plan, are plans where you invest a lump sum at one point of time and then withdraw gradually over a period of time. And what it does is almost something similar to what you achieve in SIP. Because you're withdrawing money over a period of time, you get weighted average exit price.
Oh.
And to that extent, I think it becomes a wonderful tool for somebody who's looking at regularity of income, but at the same time wants the corpus to continue growing. So let's say if you have invested, let's say about 1 lakh rupees and you're withdrawing a 6, 7%, 8% per month, per annum on a monthly basis. Chances are the asset class grows at faster than that rate. And therefore your corpus keeps growing and you continue to get regular withdrawal as the time progresses. So SWP allows, or systematic withdrawal plan, allows people to keep their investment invested for a long period of time while enjoying the benefit of growth in the assets as well as regularity of income. So this is indeed a great tool. This is not as commonly spoken. I'm glad you brought it out. But this is a very good way for somebody who's, let's say, retired and got a large corpus, or somebody who's looking to do a startup, like what you said, where they have a certain amount of money that they keep aside so that they keep on getting regular income or regular inflow. I would use the word inflow rather than income, by just giving instruction to the fund house to withdraw a certain amount. See, one of the best part of mutual fund industry is that the products are very flexible. It allows you to invest and withdraw at will in the denomination that you prefer, at the regularity that you want. So unlike a lot of other asset classes where to define the maturity period, you have to define the period or periodicity of your withdrawal, you are not sure whether you'll get a secondary market exit. There are penalty for premature withdrawal from, let's say, a deposit. In a mutual fund, you can choose to invest at one point of time and withdraw certain amount regularly while allowing almost the entire corpus or the rest of the corpus to continue to grow. So SWP works for people who have got large surpluses, and are looking for regular cash flow. It could be for retirement, it could be for maintenance, it could be for paying for some education or monthly household expenses, and then you set aside some money. The beauty of this product tends to be that your asset class, like equity, grows at much faster rate than what typically your deposits or debentures or or interest will grow. And therefore, your asset is continuing to clock in at high rate of return, while you also meet your objective of monthly cash flow that you need.
An absolute pleasure talking to you as always, Suresh. I look forward to many more conversations on WealthWise. Thank you for taking time out to speak to us, and wish you all the very best. Hope to speak to you soon. Thank you.
Thank you, Vivek. Great talking to you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.